Global equities rallied strongly over the first half of 2019, with many markets delivering double-digit gains. The first quarter started off on strong footing, with stocks rebounding from the steep sell-off seen in the fourth quarter, as sentiment was boosted by hopes of improved U.S.-China trade relations and monetary policy U-turns from key central banks. Equity markets moved higher until May, when global stocks suffered a setback as trade talks between the U.S. and China broke down. Central banks rose to the rescue in June, issuing a series of dovish comments which caused stocks to rally once more and countered concerns over geopolitical risks and slower economic growth. Looking at the U.S. market, almost all sectors recorded double-digit gains in the first half of 2019. Technology stocks led the advance, with cyclical sectors such as consumer discretionary and industrials also rallying. Healthcare stocks were the only exception, as their advance was moderated by concerns over drug pricing and growing Democratic support for Medicare for All system. Outside of the trade issues, markets are building hope for a second-half recovery, driven by stabilization in the Chinese economy, continued steady economic growth in the U.S., and potential rate cuts by central banks to help stimulate growth. At the recent G20 summit, President Trump said the U.S. will hold off on raising additional tariffs on more than $300 billion of Chinese goods, while negotiations restart between the two countries, where they left off in May. With talks resuming, there's higher probability for a base case scenario for the U.S. and China to come to a resolution on trade. This is in the best interest of both parties, not only from an economic and market perspective, but from a political perspective with the upcoming U.S. elections in 2020. However, the negotiations could still take more time, and any setback could cause volatility again in the markets. We don't believe the volatility caused by the trade rhetoric will change the long-term opportunity presented by artificial intelligence. In times of elevated volatility, risk management and staying active is critical to take advantage of opportunities. The global AI strategy invests across a broad spectrum of technologies and sectors, embracing the disruptive power of AI. AI has the potential to disrupt every industry. We have been active in the portfolio in recent months, with several new stocks being added. In AI-enabled industries, new additions include companies such as Roku, Uber, and Progressive Insurance. Roku is a leading manufacturer of video streaming devices and digital TV operating systems. The company has over 30 million over-the-top streaming users and has developed a popular advertising-supported digital streaming channel. The content offering is personalized to users using AI, while its digital ad platform also benefits from machine learning and AI to deliver targeted ads. Uber is the market leader for ride-sharing, with over 65% market share in its markets it serves. The company also has early efforts in the areas of food delivery, freight delivery, and autonomous driving. Matching riders with drivers and finding efficient routes in real time requires massive amounts of data, machine learning, and AI. Over the long term, we view autonomous technologies as having the potential to radically change ride-sharing and car ownership trends. Progressive is a leading provider of personal, automotive, commercial, and specialty insurance. In its auto insurance business, a growing percentage of its policyholders have opted in to use new telematic IoT sensors in their cars to offer usage-based insurance and offer discounts based on better driving habits. This has enabled Progressive to deliver competitive pricing to help gain market share while having among the lowest rates in the industry. In AI applications, new stocks include companies such as Microsoft. Microsoft has a growing number of investments in AI that are helping new and existing products. The company has woven AI into its Azure cloud offerings, office productivity solutions, and consumer experiences. These new capabilities are driving higher levels of customer adoption and additional growth opportunities. In AI infrastructure, recent additions include NXP Semiconductors and Marvell Technology. NXP designs semiconductors, components, and solutions targeting the communication infrastructure, data center networking, automotive, industrial IoT, and consumer electronics. The company's products are a critical component in a growing number of solutions for the build-out of AI infrastructure. Marvell designs analog, digital, mixed-signal semiconductor solutions for the storage, telecommunications, and consumer markets. company's products help enable AI applications at the edge of networks where transmitting large data volumes for analysis may be more challenging. In addition, Marvell is benefiting from the growing demand for 5G networking and storage of big data. Many of our AI-related companies are performing well with solid financial results and growth outlooks. We feel confident that their share price will follow the earnings growth over time, with the current portfolio expected to drive low 20s earnings growth over the next several years. We are excited about what the coming years will bring and to see how AI technologies can be leveraged to improve people's lives and transform world economies.